Hey everybody, what's up, how's it going? Welcome to today's video, and in today's video I'm going to be sharing with you guys 13 dividend stocks inside my Wealthsimple trade portfolio. So in today's video I'm going to be doing a deep dive and analysis of all the stocks I own. I'm going to share with you guys how many shares I have. I'm going to show you guys the total return, and we're going to be diving down and I'll show you guys my opinions and thoughts on all these stocks that I have inside my portfolio. So it's been a while since I did one of these videos, so I figured it'd be time to do one. And of course guys, if you guys enjoyed this video, please be sure to give it a big thumbs up and subscribe to the channel if you guys want to see more Canadian-based dividend investing content. And in today's video, we're going to be taking advantage of the Wealthsimple Trade desktop beta app. So let's jump over to the app and let's see how our stock portfolio is doing. Alright guys, so here we are in the Wealthsimple Trade desktop beta app, and this is a cool app that they've released over the past month. Some people have access to it, some people don't. I was fortunate to have access to it, so if you guys don't have the desktop app, you can use the mobile app, but in this video I'm going to use the desktop app because it's a little bit easier to read and everything's laid out a little bit better. So we're going to jump into stocks in just a second here, but I just want to mention really quickly that I built this portfolio on this channel in early January 2020. I did a bunch of videos. There's a long series of dividend investing case study videos, and I update them about once a week where I show you guys the stocks that I'm buying and adding inside this portfolio. And throughout the year I've kind of learned about this portfolio. I bought a lot of things that I didn't necessarily need in the beginning, so I have a lot of extra stocks that I probably, and I'll show you guys the ones that I'm going to be keeping and the ones that I'm more excited for the future, and I'll show you guys with the ones that I don't really care so much about. But there's a couple in here that I kind of just bought in the beginning, and maybe they weren't the best things to have, so I'm probably just going to hold them till they go up, and then I'll probably sell them and switch them for some more reliable stocks here. So the first stock we're going to jump into today is Algonquin Power and Utilities Corp. So Algonquin Power and Utilities Corp is a nice Canadian utilities-based stock that has grown pretty well in the past decade or so. As you guys can see on the graph here, the stock just keeps growing and growing. It's a very good growth stock, and it's also a very good dividend stock, currently having a dividend yield of about 3.98%, about 4% dividend yield. So the nice thing about this stock is it's a very defensive stock. It's something, their earnings just keep growing. They've done well through the pandemic, and they're just one of those stable stocks that just keep growing. And I'm a big fan of this power and utilities company, and I think they're probably one of the best ones out there. And as you guys can see, the growth has just been really good. And the nice thing about it is it's a stock that has a very, very good dividend yield, but also has good stock appreciation. So there's those two things going for it here. And inside my account here, I currently only have one share. I bought this stock about, I think it was a week or two ago, and I'm definitely going to be adding some more individual shares of this company because I really think it is one of the better power and utility corps company to go into the future. So if you look at some stats here inside Wealthsimple Trade, you can see here, guys, that I currently own one share, total value about $20.89, and all-time performance in my portfolio is 2.65% plus, and it is about 0.34% of my portfolio. Alright guys, so the second stock in my portfolio is Bank of Nova Scotia, and Bank of Nova Scotia is a strong Canadian bank. I'm a big fan of all the big Canadian banks, and the funny thing about the Canadian banks is I started buying them before I started buying an ETF called VDY, and VDY is a Canadian-based dividend ETF. I'll show you guys later on this portfolio. It's one of the main ETFs I hold inside this portfolio, but it's heavily based at Canadian banks, so I have a lot of individual shares of these banks I bought in the past, and I probably won't be buying individual shares of most of them because I do have them inside that ETF, and instead I'm probably going to focus on buying maybe individual shares of like one or two, probably most likely TD since it is my favorite bank stock, but that's probably what I'm going to do in the future. So if you see these individual shares I have of the banks, I'm going to stop buying them over the next little while, and instead focusing on buying more shares of VDY, maybe focus on TD since it is like my favorite bank stock by far. So currently at the time of recording this video, the nice thing about Bank of Nova Scotia is it's got a really high dividend yield of 6.3%, pretty crazy for a bank stock. The growth over the past decade or so has been pretty solid, and if we go over the returns over the past pandemic, they still have a lot of room for recovery. So I think the stock is poised to do really well in the future, and it's a really good bargain buy. A lot of these Canadian bank stocks are though, so I think Bank of Nova Scotia is no different here, but really nice good dividend yield. Their quarter three earnings were pretty solid, nice recovery, so that's good to see as well. So I think this is going to do fine going into the future, and I think this is a really good deal right now, as are most of these Canadian bank stocks that I talk about. If we go over the stats here, out of the three shares that I own, it's a total value of $169 inside my portfolio. We're currently up 1.38% with BNS, and is currently 2.77% of my portfolio. Alright, so moving down on the list here, we have CIBC, or CM for the stock ticker, and this is probably my second favorite Canadian bank. Really, really good bank. I might buy some more shares of it here and there. I'm not too sure. Once again, it is a large holding in VDY, so I'm probably not going to be buying any more shares going in the future. But CIBC is a really good bank stock. Once again, just like BNS, they have really strong dividend yield. They recovered quite a bit during the quarter three earnings, so as long as going into the fourth quarter and next couple of years, they can continue to get that momentum going. They should recover, and buying the stock right now now is a really, really good bargain deal. Just like most of these Canadian bank stocks I've already mentioned a couple times now. I currently own 2 individual shares, total value of $202, and all-time performance it's up 8.51%, which is pretty solid. As you guys can see, I bought most of these shares over the past couple months, so they've recovered pretty well, and it's about 3.31% of my total portfolio. So I think CIBC is a good buy, just like any of these other bank stocks that I've mentioned. So the next stock on the list is Enbridge, and Enbridge is a funny Canadian stock. It currently I had a lot of mixed opinions about Enbridge in the past, but you know what? Going forward, looking at like their income and stuff like that, the fact that they recovered quite well going into the third quarter, like they had a horrible second quarter, but the third quarter is pretty good. And I think this company, like where it is right now, there's a couple concerns about it because the stock price is dropping, as I'll show you guys in just a second. But I think it does have potential. It's kind of a bit of a riskier utility stock if we compare it to like Algonquin Utilities or Fortis, which is next on our list. But I think Enbridge is still pretty solid. I do have a good holding of it in VDY. So going into the future, I won't be buying any individual shares because I don't want too much Enbridge. I think it's a good stock to buy. And if we look right now, it's actually paying a pretty good dividend yield. It's got I think it's got a lot of room for growth going into the future. And like I mentioned, guys, I wasn't lying. The dividend yield is currently sitting at 9% here, 8.88%, which is pretty crazy. As you guys can see, there's a little bit of concern as the stock price has been dipping down over the past, looks like about 5 years or so. But I think this could just be showing us that maybe this is a good time to buy Enbridge, because if it does recover, it could recover really well. But once again, it's a little bit of a riskier play, so I'm not going to go too crazy with Enbridge. I'd much rather prefer to invest in like some more defensive, stable stocks like Fortis or Algonquin, but I am going to hold a little bit of it, and I probably will be buying a little bit of it in VDY going into the future. But for now, I'm probably not going to buy any more individual shares, and I'll give you guys a quick little update here inside my portfolio really quickly. Where did Enbridge go? Enbridge right there. So we look at the holdings of Enbridge inside my stock portfolio. You guys can see here that we currently have 3 shares, 109 total value, and performance is down at negative 11%. So quite a bit of down. But once again, if you guys want to take a more riskier play, this might be a good time to buy Enbridge, especially getting that nice dividend yield. But that's up to you guys if you guys want to make that play. And of course, next we have is Fortis, and Fortis is almost like the more stable, more secure version of Enbridge. I think it's a good utilities company. I'm trying to balance it with Enbridge. I think doing a bit of both is probably the more safer play. I think they're both probably going to do well going into the future, but I just think Fortis is a little bit more of a growing company. And they've just kind of done well for the past little while. So a couple things to point out here really quickly before we dive into the next stock. Fortis has nice growth, as you guys can see, over the past 10 years. Very good, consistent growth, unlike Enbridge, which is kind of dipping. And the dividend yield is a little bit more sustainable. I know that 8% or that 9% yield of Enbridge looks really nice right now, and it could be good going in the future. You never know. But this 3.69%, this almost 4% dividend yield is a little bit more sustainable, especially going into the future. And, you know, their dividend growth has been quite good and quite impressive over the past couple years, past decade or so. So getting that dividend growth, I think maybe Fortis has a lot more room for growth and a lot more room for stock appreciation. It's a little bit more of a stable stock to buy right now. And going inside my Wealthsimple trade account, we'll check out Fortis. We currently own about 4 shares. Definitely going to be buying a few more here and there going into the future. $208 in terms of value. We are up 1.89%, and it is 3.57% of my portfolio. So the next stock on my list is good old-fashioned Manulife, and Manulife Financial is an interesting stock. They've kind of struggled. If you guys look at 2008, this is when the financial crisis happened. You know, a lot of bank stocks, a lot of finance-based stocks, insurance-based stocks had a really hard time, and Manulife has kind of, you know, they've kind of recovered a bit. We've seen a little bit of growth. I mean, the stock is only $18 Canadian, so even just a little couple dollars is good growth when you really think about it. But it's kind of went up and down. So I think it's kind of like an interesting spot right now. I think it's a good buy for a couple reasons. Number one, its dividend yield is 6%, which is it's a nice dividend yield, but it's not too crazy. They've Q3 earnings have kind of risen up again, so they're starting to get into recovery. And if we look at since the pandemic, they have not recovered at all in terms of stock price. So this is good news. I think this means it is still a really good bargain buy at $18 Canadian. It was previously trading at about $26 Canadian, so I think there's tons of room for growth. It's got a nice dividend yield, and I think going into the future, they have been showing that they have recovered. So I'm not going to go too crazy with Manulife, but I have bought in quite a bit of shares, especially since for the, you know, it's only $18 a share. I currently own about 15 shares inside my portfolio, as you guys can see here. That's total value of $282, and we are up 1.36% overall, and it's 4.61% of my portfolio. I think I am going to buy a couple more individual shares of Manulife. I'm not going to go crazy, but I do think it is a pretty good solid stock with a nice good dividend yield going into the future. The stock we're going to talk about is Polaris Infrastructure, and this is an interesting stock, and I'm going to be 100% honest with you guys. This is probably one of the mistakes I made inside this portfolio. I bought this stock without really doing any research. Somebody recommended it to me and I just bought it, and I'm not saying it's a bad stock or anything, but looking at some of this information, if I would have researched this a little bit better, and this was like way when I first started this portfolio, so I wasn't, as educating stuff like that, and I didn't know how to properly do research, even just basic research, because looking at like some of these returns for this stock over the past decade, past 10 to 20 years, this does not look good in my opinion. As you guys can see, I mean, who knows? I mean, the stock price is really cheap, it could grow, but I just don't like the way this looks. Just looking at the growth and stuff like that, this doesn't look like a company that I would really enjoy or I would really be comfortable investing in. So this is probably the biggest mistake I've made. Good news about it is that I invested like next to nothing, and currently it's sitting at about I have 12 shares, $160. So it's like whatever. I mean, if it grows, it does. If it doesn't, it's currently down about -3%. But I didn't know anything about Polaris, and I still don't. And just by doing a little bit of research, it doesn't look like a stock I'm going to be interested in. So here's the lesson, guys: is always do your research. Always, even if it's just basic stuff like looking at the basic financials, looking at the stock growth, looking at the dividend growth, even just the basic stuff like that will give you a good idea whether a stock is worth investing. And that's something I never did with the stock. So I'm not saying this is a bad stock. It's just something I'm not interested in buying in the future, and I'm probably just going to let it sit inside my portfolio until it grows in value, and then I'll switch it over to something that's a little bit more reliable. All right, next stock on the list is Transalta Renewables. This is an interesting power-based generation company, as you guys can see here. I'm going to bring up the stock price here on Google in just a second. And as you guys can see, this is a pretty new company. They were founded in 2013, and I took a bit of, I wouldn't say a gamble, but I liked what the company was doing. They have nice growth. They have a good dividend yield. I'm pretty sure they have a monthly dividend payment as well. And they've been up and down, and they went down quite a bit earlier this year. As you guys can see, when the pandemic happened, they dropped quite a bit. And this is where I bought a couple shares, and I've been buying a few shares here and there. I think they have a lot of potential. I wouldn't go too crazy, but the funny thing about it is because I bought it when it was really, really low, it's actually grown quite a bit in my portfolio. I think it's my highest performing stock percentage-wise. I only own 17 shares, which ends up being about $300 in total value, but it's up 17%, so that's quite a bit of good gain. I'm probably going to keep buying a little bit here and there. I'm not going to go too crazy with it, but it's probably my best performing stock in terms of percentage-wise on this actual portfolio, so that's kind of interesting. Definitely something to look out for in the future. I think they have a lot of potential. It's about 4.8% of my portfolio, but I do think Transalta Renewables is a good stock to buy. I do have a lot of utilities and power-based stocks, so I'm trying to and that's the reason why I haven't gone too crazy with it. So in the future, I definitely want to diversify my portfolio just a tiny bit to kind of move away from that. But I think it's a great stock, and if you don't have a lot of power or utilities companies, this might be a good one to add to your portfolio. Next stock in my portfolio is Royal Bank of Canada. I currently own one share. I'm not going to talk too much about it because once again, RBC is just one of the big banks. Really good stock. It's actually the #1 weighted holding in VDY. So there's really no reason for me to buy it. I bought it way back in the day before I started buying VDY once again. So I own one share of the stock. I guess it's down negative 0.5%, but it is a good company. It's a good Canadian stock. It's worth buying. So I'm not going to talk too much about it. Like I mentioned before, the big banks of Canada, in my opinion, are always good buys. Like the RBC, the TDs, the CIBCs, the Bank of Nova Scotia's. All that stuff is always really good buys. So I bought an individual share. Once again, I'm not going to be buying in the future because VDY is my main ETF, and it just has it in there. So there's really no point. But I just want to give you guys a quick little update on why I actually have it inside my portfolio. Next stock is Severia Corp. Severia Corp is a accessibility company. I bought this kind of to diversify the portfolio and to go inside and maybe kind of make a bit of a growth, like buy something that I think would grow going through the pandemic. They had tons of growth over the past couple years, but they've kind of been up and down since the pandemic happened. I do think they will do well in the future because, that healthcare and all that kind of stuff, and, the healthcare and for the elderly and the disabled and stuff like that is definitely getting more serious. So I think there's a lot more potential and there's a market for that. In the past couple years, they've done pretty well. As you guys can see on the graph on Wealthsimple, they had a lot of growth here in the past little while. They've kind of, been up and down. Funny thing about this is when I bought it in March, it went really low and then it went super high. And I remember sitting at like a 20% return, but then it dipped back down again. So it might be a good time to buy. I'm going to buy a couple shares here and there. I'm not going to go too crazy with Severia because once again, I think it's a good stock, but I want to diversify. So I'm not, it was kind of there for that reason. And I started buying it because it grew a lot, but it kind of lost a lot of value. So it could grow in the future. Nobody, it's definitely a good company. So I'm probably going to be adding a couple shares as time goes on. Currently own 8 shares, which is $114 total value. We up 2.73%, and it's currently about 1.87% of my portfolio. Moving on inside the portfolio, we have Shaw Communications. Shaw Communications is an interesting stock because they're one of the when it comes to Canadian dividend stocks, they're a classic. Shaw Communications, I even have my internet from them. They have internet, telecommunications, all that kind of stuff. Shaw is a pretty big company, and they've had decent returns over the past little while, but nothing too crazy. But in fact, there's a couple other telecom companies and not those communication type companies. And the next one we're going to talk about is actually Telus. And I think Telus is maybe the better buy going in the future because they do have strong growth. Shaw does have a nice strong dividend and a monthly dividend and okay growth over the past little while. But I think there's some other companies that might be some better buys going further in the future. But the funny thing about Shaw is it's actually the first stock added inside this portfolio. And I mostly bought it because of the strong monthly dividend. But looking back now, I don't think Shaw is a bad company. I just want to go for some more companies that have just shown that they're growing a little bit better than Shaw. I'm still going to keep the shares inside here, and I do buy Shaw. It is in VDY once again, so I think it's a good company to hold, but I'm just not going to go too crazy with it. We currently have 11 shares of total value of $247. We are down about 5%. Shaw has not done quite well since the pandemic, but they've not done horrible. They've kind of recovered, but they're kind of like, not doing the greatest. So we're going to hold in the future because, they're still a good company. They still have good earnings and stuff like that, and they have a good dividend. So I think going into the future, they probably will recover at some point, and you can get a nice little gain. I'm just not going to go too crazy because the stock growth has not been super crazy in the past little while. And like I just mentioned earlier, I think Telus is probably the better company to buy. I'm a big fan of them. I love their subsidiaries. They have Public Mobile, Kudo, and all those companies. I think they're a really good stock. And if you look at their earnings, their growth of the past couple of years, just steady growth. I think this is probably one of the bigger telecommunications that's going to grow. Their earnings keep growing. They just keep diversifying. They keep adding new things. I think going into the future with like the 5G networks and all that kind of stuff, I think they're going to do quite well. So as you guys can see, we have 3 shares of Telus here, total value of $70. I just bought this stock a couple weeks ago, so going into the future, I'm probably going to be buying some more individual shares. Definitely one I've been looking at lately, and I like it. It's got good dividend yields and whatnot, good dividend growth, and good stock appreciation. So I think this is a really good stock to hold long term. We have 3 shares, $70, currently down about, I guess we're sitting around 0 or so. It's 1% of my portfolio. It does have a heavy weighting in VDY, but I am going to double down because I do think it's a good stock, and I want to buy more individual shares for my portfolio. And last but not least, we have my favorite stock. Probably my favorite Canadian stock is TD, Toronto Dominion Bank. TD has just had absolutely crazy growth over the past 2 decades, and they've had absolutely crazy dividend growth over the past 2 decades as well. They're one of my favorite stocks, and I think right now, since they haven't recovered from the pandemic and they've showed that their Q3 earnings have just been so good, I wouldn't say like crazy good, but there's been that recovery. I think they're just such a good buy. This is probably one of the most undervalued stocks right now, and TD just keeps growing and growing, and they have a good dividend yield. The current dividend yield is sitting about 5 or 6%. I think TD is probably one of the best undervalued stocks to buy right now. And even though, once again, I do own it, it's got a strong weighting in VDY and some other ETFs. I'm probably going to double down, and I currently have 9 shares, $534. I definitely want to buy more of TD going into the future. They just keep growing, and they've just had really good dividend growth as well, which is the whole point of this portfolio. I think TD is probably one of the best growth and dividend-based stocks that have just done well over the past decade or so. So our all-time performance is down right now, obviously because of the pandemic, but I do think this is just showing us that this is such a good time to buy, such a cheap price, and I think TD is a very, very undervalued Canadian stock. And last but not least, guys, we have some ETFs here. VDY is the main ETF we hold, as you guys can see. It's probably one of the better Canadian-based, dividend-based ETFs. I think they're probably one of the solid ones. Really, really good returns, really good companies. As you guys can see, a lot of the solid Canadian companies are in VDY. Although it isn't super diversified, I still think it's a really, really good ETF to hold. It's currently trading about $28. We have 62 shares, which is $1,794 value in total. We're currently down -4% because obviously things have been dipping down over the past little while. But I think going in the future, they're going to do quite well. And then the second ETF that I just recently started buying to add some diversification to the portfolio, we're going to buy a little bit of US stocks here and there. Going to be VYM. Once again, really, really solid Vanguard fund. Currently trades at $83 US. We own 2 shares, and it's up, I guess, a little bit because US stocks have had a little bit of a rise over the past couple days. We don't have any shares because we just started buying this ETF, but I'm definitely going to try to balance it out a little bit with VDY just to add that little extra bit of diversification. And I know American stocks get taxed inside a TFSA, but that's perfectly okay because the stock appreciation is pretty solid. I'm okay with paying the tiny bit of tax that I pay to get that nice stock stock appreciation as time goes on, if I do ever intend to sell. And these companies, US companies traditionally do grow better than other companies. Going down the list here, we have some ETFs I bought in the past, but I'm no longer interested in. VYMI was one I bought for to go into international, but I have so much international stocks inside my main growth-based stock with Wealthsimple. I don't need any international stocks. XHD was the first US-based ETF I started buying, but doing some research and whatnot, I really don't like XHD. Instead, I like VYM a little bit better. So I'm moving away from XHD. I obviously still have a lot of shares of it, so I'm just going to let them sit and they can grow on their own if they want. And then XRE we have here is a Reit. I moved my REITs inside a different portfolio. I'm no longer really interested in buying it inside this portfolio, so I'm just going to let it sit there for now. It can get some dividends. It can keep growing on its own, and we'll wait and see how it goes. And then we have ZWC, once again, another ETF I bought in the past. I'm no longer interested in. And I know I have a lot of holdings inside here, but I'm looking to kind of shrink them down and kind of focus a little bit more as time goes on. That's like my main focus. In the beginning, I bought a lot of different things, but now I want to focus down on some different things. So I'm just holding these ETFs in here. Maybe when they go up over time, I'll sell them and then I'll switch them, kind of thing. But that's pretty much my game plan for the portfolio. And once again, guys, before we end this video, I just want to do a quick little update on the dividend earnings. Every single month, I like to track the earnings inside this portfolio, because the main purpose of the portfolio is to make enough money that I can live off it, or I can pay for a good chunk of my expenses with my dividend income. And of course, we're reinvesting these dividends so that they can grow over time and we can make more and more money with compounding interest. So in our first month, as you guys can see here, we made 44 cents, and then $1.61, and then $4, and then $5, and $7. We just kept growing it, and over time, it's starting to get pretty big. Our month in September, we made $20, and October we made $20 as well, so it's just starting to grow. In November, it's only the 6th of November, we already got $8. So as you guys can see, just being consistent, regularly putting money into a dividend-based portfolio, and they do grow, and it is nice to see. And I love monthly dividend income, definitely feels good. And total dividends is $106 inside this portfolio, which is pretty sweet, with 5,175 contributions. So like I mentioned, it's slowly starting to grow, and it's definitely starting to get there. So hope you guys enjoyed this video. Please let me know what you guys think in the comments, and once again, if you like this video, please give it a big thumbs up. And remember, if you guys want more Canadian-based content, be sure to subscribe to the channel. Thanks for watching today, guys. I hope you guys enjoyed this video. Let me know what you think, and I'll see you guys later.